Hello friends, welcome. Friends, today I am going to take you through a newspaper article which came out on June 24, 2024, which talks about our current account deficit, and it says that it has reduced to 0.7% of the GDP from 2% in FY23. Now, current account deficit is what? The flow of dollars in, dollars out, and in India, when you do a balance of payment statement, there is a deficit. Now, the deficit is measured with reference to India's GDP, and in year 2023, there was a deficit means negative. Our outflow was more than our inflow. So that was to the account of 2% of our GDP. Now this year, fortunately, the number has reduced to 0.7% of the GDP, and there is a record surplus of 0.6% in Q4 of FY24, which is year ending March 31st March 2024. Now it might look very complex for a beginner who doesn't have any understanding about this headline or macroeconomics or what this balance of statement is all about. Now, friends, what I am planning to do in this video, and I was requested by somebody who is a YouTube watcher to do this video, which I could not do because of auctions were going on. I was doing a lot of processing and analysis for auctions. So now that has gone behind. So I was thinking of focusing on this video, and that's the whole purpose of this recording this video today. Now let's go straight to my dashboard. Then only you will be able to understand the importance of this headline. So let's look at the number. First number was 0.7%, which is negative 0.7% of FY24, right? So this year, the current account deficit, this is the current account deficit, the number has been reduced to 0.7%. So you can see here, my calculation says minus 0.65% of the GDP, which is roughly equal to 0.7% of the GDP. Now in FY23, the number was, as far as my calculation, it was minus 2.02% of the GDP, which is the current account deficit. Now, what the headline says, 2% of the GDP, which is kind of approximately correct. Now, if I do a quarter time scale, you will see that number throws up, and just be with me. I'll explain to you each and every item of this dashboard, and you will understand what balance of payment is all about. I'm just throwing the number before you. See, 0.61% of the GDP in Q4 FY 2024. Now, having seen the numbers of the headline, because that was the preparatory work which is required for me, for the viewers to have interest in this discussion. Otherwise, there is no point in having this discussion, because it is not an macroeconomic class. It is about practicality of the information and how it maps into India's economy and how India's economy is performing. I am not here to explain to you macroeconomics or how the balance of statement works. That's a separate part of the discussion, which you can very easily read books or go through your internet. There are multiple videos which are available which will explain balance of statement. I am looking at hard data. Okay, so let's look at the hard data. But before we go into the data, let's first understand, at least from a very high level point of view, what we are looking at. What is this BOP all about, right? You can have a detailed understanding of BOP separately, but I am not going to go into that. But let's look at it on a high level. Now, what is BOP consists of current account and capital account. So there is this particular sheet that you have in front of you. This consists of current account, and I'll explain to you what current account is. And then we have got another dashboard right in front of you, which basically takes you through the capital account. We are going to talk about this also. The capital account has been broken down into two sheets, but the main elements have been captured in this sheet, right? And then there are loans and other which are very, very marginal, so we'll not focus on them. Now let's go back to our main sheet, which is the current account. Now, current account consists of what items? Current account consists of the which I have mentioned here, 1.1 plus 1.2. So I am following the same nomenclature which RBI follows in their sheet. I'm not going different because there is no point in following a different nomenclature because people will get confused. So RBI also follows the same nomenclature. 1 current account, 1 plus 1 plus 1 plus 2, 1.1 plus 1.2. Now what is 1.1? This is 1.1, merchandise. And what is 1.2? It is invisibles. Now invisibles will be further broken down into further items we will talk about. Merchandise is what? The trade of goods. Not services, goods, the main goods that we basically encounter and we measure trade, like for example petroleum, electronics, gold. There are various other goods which we export, import, and depending upon that we have an account which says that whether we were positive as far as trade is concerned or we were negative as far as our trades are concerned. Now you will notice that since FY22 Q1, because this is a quarter time scale, you will find that as far as merchandise are concerned, we have been negative. All around we have been negative as far as our trade deficit is concerned on account of goods. You see, it's all negative. Now let's look into these items. You will see that how this item actually have changed over a period of time. The merchandise in FY22 Q1 was 4.41% of GDP negative, means that was a deficit as far as our imports were higher than export. In FY22 Q2, it was minus 5.87. Now it has been increasing, and FY23 Q2, it went as high as 10% of the GDP, and then 8.61%, and then 6%, then 6.6%, 7%, 7.69%, and 5.42%, which means that in Q4 we actually have done better as far as our merchandise trade deficit is concerned. But at this granularity, which is quarter level, it does not tell the story because it actually has seasonal elements. So if we are going to focus on this item, the merchandise item, which we will talk about the other items also, it is better to look at the yearly time scale, because the yearly time scale will give us a larger picture and the seasonalities are going to get smoothened out, and we will be able to get a better understanding where we are as far as our merchandise situation is concerned. So you will notice that in FY14 we were pretty bad, around 8% of the GDP as far as merchandise is concerned, our trade imbalance. Then 7.2, then 6.9, then 4.87, then in FY18 it was 8.26, then 6.68, 5.61, 3.86, then 8% in FY23, and this year it was 6.8%. Now, I'll tell you why these are changing over a period of time. See, the main element which is driving this change is petroleum. If you are going to have a higher petroleum import, then you are going to have a higher merchandise trade deficit. And electronics is also playing an important role, but in electronics, the steady growth is happening. Petroleum is like undulating. Sometimes the demand, sometimes the value is high, sometimes the value is low because of international oil prices. So if you look at the trade deficit data, you will find that if you have done better, it is because the volumes that you have purchased will remain same, but the value of the import as far as petroleum is concerned might have gone down because of the oil prices. If you are able to extrapolate better prices because of Russian import that we have been able to do in the last year or last 1 year, so we have been able to do better. As far as volume is concerned, we are not basically any way conserving petroleum product. The volume is increasing, but the value is fluctuating because of price. So this is the main item which is kind of driving our merchandise trade deficit. We are not doing better in electronics. I'm not going to digress here, but if you look at the chart as far as electronics is concerned, you'll find that our trade deficit on electronics have been increasing in spite of the fact that we have been doing a lot of PLI for last couple of years or 3 years, but it has not improved. So that is one. The second item, which also is very important, and let's continue to look at the yearly time scale, which is invisibles. Now, invisible is what? Invisible, which forms also the current account, form the part of the current account deficit, which is 1.2, includes 3 important items. Now these are subcategories, which is 1.21, 1.22 2 points, actually 1.2.1, 1.2.2, 1.2.3. Now 1.2.1 is services. Just like we do trade in goods, similarly we have trade in services. And then we have 1.2 is transfers, and we are going to talk about transfers. And then we have 1.2.3, which is income. Now, as far as services are concerned, there are 4 important items of services, which is 1.2.111, which is travel, transportation, insurance, and there is miscellaneous, right? GNIE and then miscellaneous. So there are actually 5 items, right? So if you look at that, there are 5 items, and the miscellaneous can be further categorized into other items 1, 2, 3, which is software services, business services, financial services, and communication services. Now, if you look at these 4 items, these items are pretty small. The main contribution as per services are concerned is coming from software, because that becomes a part of the miscellaneous services. You see, the software services are the main contributor of this item. So if you look at this item actually, the services which forms the part of invisibles have been increasing as a percentage of GDP, and we have been doing reasonably better, at least in last 2 years. Though if you see, it is all 4%, is roughly around 4%, this is less than 3.5%, this is 3%, then 4%, then 3.4%, 3%, 3.3%, 3.4%. Now in last 2 years, we have done better. So this stands out. If you look at from year FY14, FY23 and FY24, we have done better. And why we have done better? Because of these 2 items, software services. See, 4% and 4%. Roughly around 4% is much better than what we have done earlier. So that stands out. Because of services, we are able to achieve a better invisible surplus. Because of software services, because the other things also we are going to talk about, because let's focus only on services first. So you understand that services are primarily driven by software services, and the rest of the items are very, very marginal. And only last 2 years we have been doing very good as far as software services, which is a very good thing as far as India is concerned, right? Which is much better than the percentage of GDP what we did in FY22 and before. Now let's look at another important item, which is 1.2.2. If you do see this second element, which is transfers. Now what are these transfers? The transfers are nothing but people going out of India, they are making income there, and they are transferring their income in India, and that is considered as transfer. Means whatever you are earning there, you are basically sending to your loved one in your family. So that transfer has remained steady. You see that it was around 3.53% of GDP, then 3.26% of GDP, then roughly around 3%, 2.43%, 3.32% to around 2.59%, then 2.68%, 2.74%. But last 2 years, it is 3.05% and roughly around 3%. So you can say that if you leave this FY14 aside, and if you consider from FY15 till FY22, last 2 years have stood out. As far as transfers are concerned, it's almost similar to what we have done as far as software services. Last 2 years have stood out, and that is helping our current account deficit. Now you understand there are 2 important items: software services and transfers. These are the main contributor to invisibles, which is pulling down our deficit and making this line item better. Okay. Now let's come to another important item. Now, see, transfers actually consider 2 items, official as well as private. So forget about the official part, because we are only interested in private, which is a huge amount of money. That's why I focused on the main item, not the sub-items. Now, income is an investment income which the foreigners make in India, and they take that income out of the country. Why it is called income? Because it could be positive, it could be negative. India is also making investment outside India into foreign countries, and foreigners making investment in India. So the net is this particular value, right? which we are seeing here. Income consists of two items, investment income and compensation to employees, means the people who are working in India, they are being paid from their foreign counterpart, and that's this item. Now this item is small, so let's focus on the investment income. Now if you look at the investment income, you will find that the investment income means people who are making investment in India, in India, they are extracting their profits out of our country in terms of cash flow. So that is resulting in a negative impact on the current account deficit, and it is pulling the current account deficit by that amount. Now you look at this income, it started in FY14 1.25% negative, then 1.2%, 1.16%, 1.14%, 1.48%, 1.07%, then 0.97%, then 1.34%, all negative, then 1.18%, and in last 2 years again if you see the number is quite high. So which means that though software services and the transfers are helping pulling down our current account deficit, but the income, which is not significant, but it is still a larger portion of what it used to be in the earlier financial year. So this is important, right? So let's summarize. We have merchandise, which we have in the last year we have done better, but in the earlier years we have been undiluting because of petroleum. Services, software services, we are standing out. So we are standing out, no doubt about this. We are standing out on software. That's why the miscellaneous is going up. And then we had standing out on private transfers, right? Which is increasing, and then the income is pulling down, which is the income which are extracted out of our country is pulling down our current account deficit, CAD, because this is having a negative impact as far as our dollar inflow. Now let's go to the next tab, which is the capital account, because we have to look at both the current account as well as capital account to look at the full CAD, the current account, the balance of payment situation. Now if you look at let's be first give you the BOP main item, how it basically adds up. So if you see overall balance of payment, which is the line item 61 here, because then only you will be able to understand, otherwise you will forget, you will not understand. This is the line item, the last item, which says 1 plus 2 plus 3. So we discussed in the first sheet item number 1 here. See item number 1 here. See this one, current account. And current account, what we discussed? We discussed merchandise, we discussed invisible, merchandise, invisible consists of 3 main items, services, then we had transferred, and then income, which we already have discussed, right? Now the second item out of which makes up our balance of payment is the capital account. Now this capital account is the next line of discussion that we are going to have. Now capital account is why it is important, because it also makes up a huge amount of inflows and outflows of dollars, which impacts our overall balance of payment. Now if you look at this, you'll find that the capital account consists of 5 main items: 2.1, 2.2, 2.3, 2.4 and 2.5. The 2.1 is foreign investments, and I'm going to discuss individually these items. Then we have 2.2. Let's go to for 2.2 we have to go to the next sheet. Let's go to 2.2. Now 2.2 is loans. This is 2.2, right? This is 2.2. And then we have got 2.3 banking capital, and then 2.4 rupee debt services, and then we have got 2.5 other capital, right? These are things. Now you will notice that these items, the loan, and then we have got banking capital, then we have got rupee debt services and other capital. If you see these line items, you will find that these line items as a percentage of GDP is very, very small. So we can simply ignore that from the point of view of discussion as of now. Let's look at the dashboard, which talks about the capital account as far as item number 2.1. Now 2.1 consists of 2 main items. Now what are those 2 main items? One is foreign direct investment. If you see here, 2.1, 2.1 and 2.1.2. Now if you see 2.1.1, this is the line item, foreign direct investment, and the 2.1.2 is the portfolio investment. Now these are the 2 items which we have to focus on. Let's go and have a let's look at the individual year item. So if you look at foreign investment, which is foreign direct investment in India, you will see that in FY14 we did 1.17% of the GDP, and then it is 1.55% of the GDP, then 1.71% of the GDP, 1.54% of the GDP, 1.56, 1.14, 1.53, 1.64, 1.22. Look at these. We're extremely bad. Now, in the last 2 years, we have been doing much better on software services, transfers, etc. But we are doing extremely bad as far as foreign direct investment is concerned. It's a matter of concern. Though we should be very happy we have done very good CAD, but this item, which was a significant item in the earlier years, suddenly in FY23 and FY24, at least in FY24, it is miserably bad. Foreign direct investment is an indicator of foreign investors' confidence in India for making brick and mortar investment. Brick and mortar investment means investment which remains in the Indian market for a longer period of time, not for a shorter period of time, which helps our country grow because it brings investment into infrastructure, into factories, etc., which has a larger gestation period. Therefore, if we are not doing well in foreign direct investment in the last 2 years, should be a matter of concern. Okay. Now let's look at the other item, which is 2.1.2, portfolio investment. Now in portfolio investment, if you see, it is fluctuating. It is very seasonal. Like for example, in FY14 it was pretty bad. Then it suddenly increased to 2.1% of GDP. Then it went down. Then it increased to 1.14% of GDP. Then for 2 years it went down. Then it basically in FY21 it increased to 1.35% of the GDP. Then in last 2 years it went. So it's like doing a cyclic kind of a situation that in every 2 years, if you look at the gap, it's a very, very cyclic. We can predict it that this year we are doing good as far as 1.24% of the GDP, but next 2 years we will do bad because there is a pattern that we can very clearly see as far as portfolio investments are concerned. So anybody making investment in the stock market should look at these macro data so that they can see the trend. Though these trend could be just by chance, there may not be any kind of hard macro data to talk about here, but there is a trend, of course, right? And there may be some element of linkage to macro, who knows, right? This is the cycle that we are able to see very clearly. And in FY22 this number was pretty bad as far as portfolio investment is concerned. Then in FY23 the number was 0.61%, and this year we have done better, but we could not do as better as what we have done in FY15, right, which was 2.1% or 1% of the GDP, right? So then we can basically break up portfolio investment in India, outside, and and abroad, because India is making there are portfolio investment which is coming in India, and then we are making investment outside India, and all those things have to be added up. So you can just pause the video and look at these line items, and you can basically refer to the RBI sheet also for your own purpose. You can understand it. To summarize here, as far as capital account is concerned, you will see that capital account we have done better in all these years where portfolio investments were good. We have been doing better, see, reasonably better, and therefore this year also we have done better, 2.42% as far as capital account is concerned, but that is not very good on account of the fact that we have done miserable as far as foreign direct investment is concerned. You can see the data, because look at this, foreign direct investment we have been doing pretty good, right, since FY14 till FY22. These 2 years was so bad, and that's why even after having done very good as far as portfolio investment is concerned, our capital account as far as the percent of GDP is not a very good number compared to what we saw in FY18 and FY15. Right? So you understand how the problem is. So when the headline comes in any newspaper, please don't go with the headline, because it gives a very false picture. You need to look at hard data to understand where the strengths are and where the weaknesses are. That's the story we should be talking about. Because by looking at the headline does not make anything. You get influenced and you may think that everything is good and everything is going well. But that is not going to give you any benefit to plan your investment, plan your maybe whatever you want to do, or maybe upgrade your knowledge. That is not going to give you any insight, because headlines are extremely misleading. Now let's go to the next chart, which kind of talks about the final balance of payment, and I'm going to just skip loans and external assistance and all those things. Just let's look at the monetary movements. Now if you look at the monetary movements is here, right? 4. Now what monetary movements, how the balance of payment statement is read, whatever you see in monetary movements, right, these is the foreign exchange reserves which are decrease and increase. Means if there is a negative, means foreign exchange reserve is going to increase. If there is a positive, then foreign exchange reserve is going to decrease. That's how it is read. The balance of payment statement is read like that. So whatever is the absolute number, if it is negative, multiply that by -1, that is going to give you the increase of your foreign exchange reserve. So the foreign exchange reserve of India has been steadily increasing, because the numbers have been, in general you will find the numbers have been negative, right? But this year this is the overall balance of payment. You see that's how it is, right? You just ignore the last line. Let's look at the foreign exchange reserve. So this year, as far as percentage of GDP is concerned, the foreign exchange reserve has increased by 1.79% of GDP. And last year, FY23, the foreign exchange reserve actually has decreased by 0.28% of the GDP. Now, there have been years where the foreign exchange reserve has increased significantly. Like for example, FY21, 3.25% of the GDP. In FY15, it was 3.05% of the GDP. Now, cumulatively, the foreign exchange reserve might show off to a very large amount, but if you compare the increment from a point of view of GDP, this year we have not done very good. The numbers are telling that story right in front of you. It is 1.79% of the GDP. Because absolute number will never give you the right picture. You have to create a reference, and GDP is the right reference to look at. So I hope, friends, that you probably have understood where we are as far as our balance of statement is concerned. I think this video might have given you a very good picture, and if you do a quarterly time scale, that is going to tell us that this year, this particular quarter, we have done better, because our if you see this is the main headline. Whenever there is a headline, when we have done positive 0.61%, then they will throw that as a headline. But you need to basically look at the trend. So I'm going to put a number 24 here, so that you can see 24 quarters back in time. Now if you look at 24 quarters back in time, this is not an exception quarter. So in FY24 Q4 is 0.61, but you will see that there have been periods where we have done even better. For example, FY22 Q1, it is 0.94% of the GDP. FY21 Q1, 3.71% of the GDP. And FY21 Q2, 2.38% of the GDP that we have done as far as our current account deficit is concerned. In many years, though we have done negative, but that's why looking at this and a granularity of quarter makes no sense. We have to look at it from an yearly, and that's why when I started this video, I told you that if you're looking at balance of payment statement, don't look at the quarter level, because it will give you a very wrong picture. It's not going to tell you the complete story. I hope, friends, that you have understood, because this video has already gone too long and I have to close this video now. I hope that you have understood the implication of the India's balance of statement and the headline which got published in the ET or other newspaper daily. The significance of this headline must have been very clear to you. So I would strongly urge those people who really are serious about learning economics, plan your data with your own hand. Don't depend on others to give you the story. You should have your own story, because there are many things which are not said or blown out of proportion. Thank you very much, friends, for your time, and I'll come back to you with a new video next time.